Decoding risk. The significance of credit ratings in corporate bond assessment. In the intricate realm of fixed income investments, few metrics carry as much weight and significance as credit ratings. For investors navigating the landscape of corporate bonds, understanding the nuanced role of credit ratings is paramount. These seemingly straightforward ratings, assigned by credit rating agencies, encapsulate a wealth of information about the creditworthiness and risk profile of issuers. This article delves into the significance of credit ratings when assessing the risk of corporate bonds, unraveling the complexities that underpin this critical aspect of the fixed income market. Credit ratings demystified. Credit ratings are shorthand assessments provided by independent credit rating agencies, such as Moody's, Standard & Poor's, S&P, and Fitch. These agencies evaluate the credit risk of bond issuers based on a myriad of factors, including financial health, debt levels, business outlook, and industry dynamics. The resulting credit rating serves as a benchmark for investors to gauge the likelihood of a bond issuer meeting its debt obligations. The alphabet soup of credit ratings. Credit ratings are typically expressed as letter grades, with variations across agencies. Investment grade ratings, denoted by letters such as AAA, AA, A, BBB, signify a lower perceived risk of default and are considered higher quality. Conversely, non-investment grade or speculative grade ratings, encompassing BB, B, CCC, and below, indicate a higher risk of default, offering potentially higher yields to compensate for the elevated risk. The significance of investment-grade ratings. Investment-grade ratings are coveted by corporate issuers as they signify financial stability and a lower risk of default. For investors, these ratings offer a level of confidence in the issuer's ability to meet its debt obligations. Bonds with investment-grade ratings are often considered safer investments, appealing to risk-averse investors in institutional portfolios that prioritize capital preservation. Consider a corporate bond with an 8 rating. This indicates that the issuer possesses a strong capacity to meet its financial commitments, with a relatively lower risk of default. Investors relying on these ratings can build a diversified fixed income portfolio that balances risk and return, with the assurance that the majority of holdings boast a solid credit profile. The perceived risk of non-investment grade bonds. Conversely, non-investment grade or high-yield bonds, while offering potentially higher returns, come with an elevated risk of default. Investors drawn to these bonds are often enticed by the prospect of increased yield to compensate for the added risk. However, the significance of credit ratings becomes even more pronounced in this segment of the market. Consider a B-rated bond. While it may offer an attractive yield, the B rating indicates a higher risk of default compared to investment-grade counterparts. Investors navigating this space must carefully weigh the potential returns against the increased risk. Recognizing that credit downgrades or adverse economic conditions could impact the issuer's ability to meet its obligations. Default risk and credit ratings. The primary significance of credit ratings lies in their role as predictors of default risk. Historical data indicates a strong correlation between credit ratings and the likelihood of bond issuers defaulting on their obligations. Investors utilizing credit ratings as part of their risk assessment can make informed decisions about portfolio construction, risk tolerance, and the overall balance between risk and return. For instance, a corporate bond with a CCC rating suggests a substantial risk of default, requiring investors to conduct thorough due diligence before including it in their portfolio. The issuer may face financial challenges or operate in a volatile industry, and investors should be prepared for heightened volatility and the potential loss of principal. Market perception and credit ratings. Beyond their predictive role, credit ratings also influence market perceptions and pricing dynamics. Bond prices are often influenced by changes in credit ratings, with downgrades leading to price declines and upgrades contributing to price appreciation. The significance of these rating changes extends beyond the individual bond, impacting the broader fixed income market and reflecting evolving investor sentiment. Consider a scenario where a well-regarded corporation experiences a credit downgrade. The market reaction may lead to a sell-off in the issuer's bonds, causing a ripple effect across similar securities. This interconnectedness underscores the broader market's reliance on credit ratings as a barometer of credit risk and a catalyst for market movements. The role of credit rating agencies. Credit rating agencies play a pivotal role in shaping the significance of credit ratings. Their independence, methodology, and analytical rigor contribute to the credibility of the ratings they assign. However, the financial crisis of 2008 highlighted concerns about potential conflicts of interest and the need for increased transparency and accountability in the credit rating industry. Investors must recognize that credit ratings are not infallible and should be used as one of many tools in the investment decision-making process. Conducting thorough due diligence, staying informed about market conditions, and understanding the specific factors driving credit ratings for individual issuers are essential components of effective risk management. The global impact of credit ratings. Credit ratings extend beyond domestic borders, influencing global capital flows and cross-border investments. Sovereign bonds, issued by governments, also undergo credit rating assessments, impacting international investors' decisions. A downgrade in the credit rating of a sovereign entity can lead to capital outflows, currency depreciation, and broader economic implications. Consider a scenario where a country experiences a credit rating downgrade due to concerns about fiscal management or political instability. The resulting impact on investor confidence can reverberate through financial markets, affecting not only sovereign bonds but also corporate bonds within that jurisdiction. This interconnectedness underscores the global significance of credit ratings as a critical element in international investment decisions. Conclusion. In the labyrinthine world of fixed income investing, the significance of credit ratings in assessing the risk of corporate bonds cannot be overstated. These ratings serve as beacons, guiding investors through the intricate terrain of credit risk, default probability, and market dynamics. As investors navigate the fixed income landscape, an understanding of credit ratings empowers them to make informed decisions, construct resilient portfolios, and strike a delicate balance between risk and reward. In a world where economic uncertainties and market fluctuations are constants, the significance of credit ratings remains a steadfast compass for investors seeking clarity and confidence in their fixed income investments.